All right, y'all, welcome to the first session of options trading.
Oh.
So the group I have mentioned before is called Optionally Rich. I think we grew up in, mostly this is curated towards people who grew up in underserved communities that don't have access to knowing about financial literacy, building financial work and legacy. And so I created this group to not only promote options trading, but to be able to, give information out about how to build wealth from various sources within the stock market and outside of the stock market as well. So one of the options that we have to create wealth is learning how to trade and use in the market. Now, the tool in the market that I personally am more comfortable with is options trading. So that's what we'll be focused on in this presentation. So like I said, our mission is to just create a greater mindset and learning how to create passive income and creating wealth to benefit individuals and our communities as well. And so this is our mission statement here. It says, thank you so much for taking this life-changing step with Optionally Rich. Optionally Rich is a community designed to equip everyday people with a knowledge, mindset, strategy, and essentials for options trading. We believe that the greatest gift is accessibility to tools and resources that could better the life of individuals. Hence why we're educating individuals about options trading and how to turn into a lucrative source of income. So have you guys done anything within the stock market?
Yeah, I dabble.
Dabble, like you buying stocks?
Buying stocks, yes, just buying and selling stocks. Mm-hmm.
Okay, can you give me like a brief summary? If someone wants to ask you, what is the stock market? What would you tell them?
I would say that essentially it's a market that allows you to have a piece of ownership in a company. As the company rises and as they profit, your stock profits. As it lowers. That's kind of like, yeah.
Okay.
A piece of ownership. That's why I would just say a piece of ownership, a stake in a company.
Okay, and Rob?
I think Q said it very well. I think though, if Q is dabbled, I've only done a teach. You know what I'm saying? I bought like a stock or two. I listened to some, maybe instructional podcasts, what have you, and talk with family members and stuff like that. So I would only mirror what Q said, that it's, you buying pieces of a company. I just had a thought though, I could be tripping, but it like the point of a stock is that the company can borrow against the valuation of the company, or like, you know what I'm saying? Like what's the value?
I mean, essentially is you're investing money into that company because you believe in future growth of that company. So the company uses the funds that they get from the investor through the stock market to, sponsor their product and things and production costs and things like that. And when a company gets to a level where they're profitable, you'll see sometimes they'll buy back shares from their investors to kind of hold some of their company's values for themselves. So as an investor, when you buy stocks, depending on what type of stock you buy, you have a voice to go into these business meetings with these companies and vote on certain things in their organizations. So it does give you piece of ownership within that stock, but there are different type of levels of stocks that you can buy within a company, and based on the level that you buy, the more voice you can give towards the direction of that.
Do you mean in the sense of like rounds of investing?
Like they have like class A, class B, class C stocks. So there's a little bit different.
I don't know what. See?
That's another, because I think I've seen it with Google, but I haven't seen it with like other businesses like that. Like with class, they got a alphabet class A and class B.
Yeah, usually when the company has like their, these big mega companies, you'll see different classes of the stocks you can own. But yeah, so essentially the stock market is a place and we'll think about the farmer's market where you can be able to buy, exchange things based on the value of the products itself. And so within the stock market, we have various products. We have equities, you have regular stocks, you have bonds, currency. So that's why we have different level of trading where you see people are trading futures, Forex, or they're trading indexes, securities. So the products is ample on the stock market itself. Just when we talk about stock market, think of it as just a venue for all these different products that are out there. We, as the regular people who are not part of the institutional buyers or hedge funds companies, we're called the retailers. So with retail, it's going to have little influence on how the direction the market really goes, unless you see situations like AMC, GME, where retailers took a hold and, kind of, stick it to the man in a sense. But on a regular basis, your retail purchases it's like a blimp into the stock market. So when you're entering into trading and learning about the market, it's very important for you to know where are the big bucks putting their money into. What are the institutional traders? Where are they going? Because when you see where they're going, that's where you'll see most of the movement, the volatility, and the increases in the market.
Yeah.
Or decrease in the market when they're pulling out and things like that. So it allows us to buy and sell products, of course. There are different ways you can engage in the stock market. You can be an investor, or you can trade, or you can do both. So people who have the investor mindset, they're here for the long run. They're Warren Buffett type individuals where they're going to find companies that are new or companies that have great value, but still have potential to continue to grow and maintain their position in the future. So people who are investors are future-minded individuals. Traders are there for income base. And so they want to be able to make money right now, get it out of the market, distribute it in different ways, and then continue to keep producing income from the market here and there. So they're more an active members of the market, and the investors are passive members of the market. Any questions concerning the stock market? No, okay. So
wait. I do got a question, but I'm sure you're gonna answer it. What I was gonna ask, what's the option? I'm sure you're gonna get to that, yeah?
Oh, we're gonna get into that right now.
Okay.
All right, so I do have a Stock 101 tab in the Discord, so make sure you guys check it out for a little bit more in-depth background on the stock market itself. You don't have to be thoroughly knowledgeable of every intricacy of the stock market to trade, but it is good to equip yourself with knowledge so you can know how to navigate through it. So what is options trading, right? So think about buying a house. So say you get a house, you see a house right now that's for, or we're not gonna say right now, because right now it's crazy in the market, but say it's the year 2020, and you saw that the housing prices dropped, and you saw a house for $150,000. And you don't necessarily have the capital to make a down payment on that house right now, but you want to lock in that price. So the broker comes to you and say, hey, you can give me this little bit of security deposit. It's not necessarily a down payment, but it's a little bit of security to say that if you can come in the future by a certain time period, you will be able to purchase this house for this price, no matter what the price is. So you're like, okay, you know what? I'm gonna, kind of purchase this little security package thing, and I'm gonna secure in that $150 price point for that house. So if they come back 2 years later, the housing market booms, and now the prices have kind of like, double for most of these places. So now the house is worth, say, about $250K. So you come back to the broker and you're like, hey, I'm gonna give you, here's this contract that we signed that I can come back no matter what the price is in the future, I can buy it for $150,000. So now you're within your time period. Say the contract was for 5 years, so you come back 2 years later and the house price is like crazy. So now the broker has to honor that because he sold you that insurance. So now you can buy that house for $150,000, even though the value of that house is $250,000. And that is how you can instantly make a profit. And so that is essentially what options initially was when they first invented it, was to be able to lock in certain prices for stocks and hopefully have the opportunity to purchase it for lower price when it has accumulated more in the future. And another example of this, say we'll go back to 2020. You see that house for $150,000. You put a security in for it, right? 2 years later, say the housing market drops and this house now is worth $80,000. You go back to the broker and you're like, hey, this house is worth $80,000. It's much cheaper now than it was when I first came here. So you don't have the obligation to buy it. You have the right. You don't have the obligation to honor that $150,000.
So you don't have to still pay $150,000.
You don't have to. It's only beneficial if you have it and it benefits you. But if it does not benefit you, you just waive that insurance money that you give, the premium that you give, the down little deposit you put down. That's what you lose. So you can lose that. Say you paid $500 for that little security. You only have a $500 loss, but then you still make it up a whole lot more because now you bought a house for $80,000. Whereas if you had originally purchased a house for $150,000, you would have been down way more than $500,000. So that's the beauty of options in the grand scheme of things when it comes to investment, being able to protect the current investments you have or the future investment you want to take, and not necessarily put all your capital and equity into that right away and then benefit from it when the market changes directions.
Hey, I'm so sorry. I'm wondering, I went through a dead spot. And
Okay.
If you could just give a quick synopsis. I understood what you were saying about but just the very beginning that you were explaining the house analogy real quick.
Okay, so which part of the house analogy?
The very first part of it's $150,000, like that, like right there.
Okay, so basically, it's 2020. A house is worth $150,000. You don't want to buy it right now, but you want to lock in that price because you still think it's a good price. You put down a security deposit on it to lock in that price for $500, right?
Mm-hmm.
So it's not a house down payment, but it's just a price that you pay to lock down, right? Yeah. So 2 years later comes, and now that house is worth $250,000. The housing market boomed. And so then you can go back to the broker and be like, hey, I paid for the security to lock the price in for $150,000. And they have to honor that price. So now you got the house for half of what it, for way less than what the current market is paying for it. Mm. So that's the benefit of options, even in the regular stock market environment. This is outside of trading. Okay. So the opposite.
At this stage, we're the buyer of the option. That's what you were saying. You could be the seller of an option.
Yeah. Okay. So the seller can lose and the buyer can win.
Yeah.
And the seller can win and the buyer can lose, because that person now, if they sell it for you for $150,000, they lost that extra $100,000. Yeah. That's the value of the house. In the other way, when we talk about if the house price drops low, right? And it's $80,000 now, you go and you had it locked in at $150,000. Remember, as a buyer, you have the right to exercise that insurance, but you are not obligated to do it. So you don't have to pay $150,000. You can decide, hey, you know what, keep my security deposit. I'm done with the contract, whatever.
Yeah.
So then the seller gets to keep $500 for free.
Gotcha. Oh, okay.
So I heard, and I guess when I heard when doing options is they say, I don't know, and I guess trying to look for more clarity on it, it's a little bit more easier to be a buyer, because it's almost like, in a way, it's not a win-win situation, but it's kind of like, if it goes up, then you're good. If it goes down, you don't have to pay all that.
Right. You're capped at what you put in. That's the max loss you get. Whereas when you're a seller, there is unlimited max loss that you're exposed to.
But then you have a also higher aspect of profit to possibly make, I'm guessing, as
Well,
well.
buyers have a higher level of profit.
Oh, wow.
margin.
Yeah.
Okay.
Sellers, they're capped at whatever that premium was that you gave them.
Because
That's the
you're
max.
betting. It's two chinks in the armor, yeah. Like
Yeah,
you're betting against the market and you're betting against the intelligence of the buyer to not
right.
understand the market, and so you kind of got an advantage. It sounds like.
Mhm. Wow.
Yeah. Hold on one second.
And then the only way you can become a seller is to be a dope buyer. So you really ahead, boy.
Yeah, it's definitely pros and cons to
That's
both
interesting.
sides. But the reason why being a buyer is a higher risk is because your profit range is significantly higher than a seller would ever get. So my profit can go up to 1,000%, right?
Mhm.
Or even more than that. There's this, guy I was trading with, and his percentage was 27,000% gain in one trade. Whereas as a seller, you are capped at 100%. That's it.
Got you.
All right.
So
So
it's
when
the
it
same.
comes,
So let me ask you one question. Does the seller have to pay out the difference in that agreement?
well, no, so for instance, in the situation where the seller is giving you that premium, that price of $150,000,
Mhm.
they own that property.
Mhm.
So when you come back and say, hey, I want to exercise this contract and get the price for this house at 150, even though the current market price is 250, they at a loss. They had a loss of $100,000. Whereas a buyer, your losses probably would be like, 500, 200
Gotcha.
for the most part. But they, like, if the price kept going up to 400,000, they lost all that profit because they had to sell it back to you for a lower price.
Okay.
All right, so that is traditionally how options even enter into the stock market. But as traders, we're not necessarily, when you are a beginner, you're not necessarily thinking about owning these shares. You have the ability to own them. So an option contract represents 100 shares of a stock or equity. So when you buy these contracts, you're saying there's two different types of options contract. There are call contracts and there are put contracts. Call contracts are if you are betting that the stock will go up. Put contract is when you're betting that the stock will go down. So you can make market whether the market is going up, money whether the market is going up or whether the market is going down, right? So with these, you're like, I'm thinking Apple is going to go up. So I'm going to buy an options contract that gives me the right, one contract gives me the right to get Apple shares, 100 shares of Apple at this price. If Apple is above this price by the expiration date. So you have the right, but you don't have the obligation. So in trading, we don't exercise these contracts. What we do is we buy the contract at a low price and we sell the contract at a higher price. And the same thing with the put contract. If the price of Apple, you have a put contract where you're saying that you're betting the stock is going to go down. If Apple drops, your put contract will increase in price. And so you're able to sell that back. And so the people you're selling it back is to other buyers who have different sentiments, or to sellers who are trying to buy back the contract that's sold already because they don't want to be exposed to a greater loss than what they already have. So that's how the basics of trading options work. You're buying calls or you're buying puts. You're either betting for the stock to go up or you're betting for the stock to go down. You buy a low price, you sell it at a high price. And that is the simplicity of it. So as beginners, we're going to be focusing on buying contracts versus selling contracts. Selling contracts is more for higher levels, and you have to kind of get a different type of account to be able to use to sell contracts. So let me put this over here. All right, so why trade options versus stocks? So we all know that you saw pictures of people probably on Instagram, social media, posting their trades alert or their trades profits, and you're like, oh my gosh, they're making a whole lot of money day trading stocks. So people always wonder, like, why would I, trade options contract versus just trading regular stocks? I own this, I own this stock, and I have an opinion on the company in some small way. So why would I give up that ownership to trade a derivative of the company itself? Because options is not, you're not having those shares of those companies. So you don't get the voters right for the company when they send out different things. You don't get dividends for those companies either. So it's like, okay, what is the profit? Why will I switch? So this is a little mathematical thing, and the price of this company is totally different from when I first created this presentation. So bear with it. All right, so with options, we are able to get into these companies for a much smaller price than it would be when you're buying the stock straight out. Nowadays, they have things called fractional shares. And so that helps the retailers who don't have money, like they don't have when Google used to be $1,000, they don't have $1,000 to buy one share of Google. So now they have the ability through fractional shares, but fractional shares don't even give you voting rights either. So it's not beneficial for you to kind of stick to the stock alone if that's what you're looking for. So with options, you're able to get into these companies for a much lower price for a greater probability rate than you would day trading. So this example, we have Apple right here. At the time of I created this presentation, Apple was worth $165.51. So if you wanted to own 100 shares of Apple, you had to pay $16,551. Y'all got that? So,
Yeah, I got that.
You got that to pay for 100 shares?
Oh, no. I got what you said. I don't got that money.
In the spirit, I got it.
Right.
Yeah.
So most people don't have this to make this. So remember, we said options contract worth 100 shares of a company. It represents 100 shares of the company. So in order to kind of get to a similar level of profit that you'll get from an options contract, you had to own 100 shares of Apple, and most people don't have the money for that. So what happens is we have a contract that we can buy. So I could talk about the call contract is when you believe the price of Apple is going to go up. So we're getting one call options. We're predicting that Apple is going to be above the price of $165 by the end of the trading day on March 25th, 2022, right? And that contract cost us $224. Now, do you guys have $224?
But yeah, we can do with that. We can do it.
You can do that versus the 16,500, right?
Facts, yeah.
Right. So this is the example of how the call contract format is. So basically, so you'll pick a strike price. When you buy call, you want the strike price to be above that by the expiration date. Mind you, in trading, we don't wait till expiration date. We can buy a contract 1 minute and sell it 30 minutes later. We can buy it 1 minute, sell it 5 minutes later. So you don't have to wait. But this is just saying that if you wanted to exercise or actually get the shares of Apple, by this date, the price of Apple would have to be above $165. So if it's above $165, then you can buy Apple shares for that price and make a profit off of it. That's how some people who are investor mindset, they would use options to kind of be able to get their stocks for cheaper price. All right, so let's say a few days goes by and now Apple stock increased by $3.44. So now the price of Apple is about $169.95, right? So the contract will now be worth $445. And then, so if you were to just buy the stock itself, the stock profit would be $344. So when you subtract the when you subtract the options price, what it's currently worth from what you buy from it, the profit would be $221. So you're like, man, I made more money paying playing the stock versus the options. But think about it. This person who played the stock had to put in $16,551. And this person had to put in $224. Their profit percentage is much lower than the options trader. The profit from the stock profit is 2.07%, while the options trader percentage is 98.7%.
Wow.
And that's why trading options is more beneficial for retail sellers, retail traders than it is for just day trading stocks, because you don't have that much capital. So now this gives you an opportunity to get into play and make greater money with using less funds. So let's think about it. So in the event happen, Apple declares bankruptcy, right? And their stocks plummet and it just like drops, like in the most unprecedented situation, Apple drops to $0. This person is out $16,551. You're out $224. So your risk is less, it's a whole lot less than it is when you actually own the shares. Because the max you lose is what you put in. Now we know people are smart enough when they see the market dropping, they won't pull out. They're not gonna wait for it to get to zero. And the same thing you'll do with options. When you know your position is going opposite of you, you're not gonna wait for it to get to zero. You're gonna pull out. There are different ways we manage our trades so that we can be able to reduce our risk if it goes against us. All right, does everyone understand this illustration? Does it make sense to you?
Yes, I'm getting it. I got it. So
go ahead.
Yeah, I think. Oh no, I was gonna say, so like if you all right, okay, so if it does go, so you're paying for an option for the 100 shares, but it's not actually the 100 shares of Apple. It's not the real, like, it's not the stocks, are they? Like, I mean, it's the stocks, but you're not really owning the 100 shares.
No, you're not.
Call option.
Okay.
You remember, it's almost just like a
declaration.
Just
like a security deposit that you're like, we talk about the mortgage example. This is like, hey, I want to buy Apple for $165. And if the price of Apple is above that by this date, the expiration date, March 25th, 2022, I have the right to buy 100 shares of Apple for $165. So if Apple somehow goes up to $200, it does not matter. I'm going to have to still, I can still purchase it for $165 and make a profit off of it.
Got you.
That's what it's saying. So, and that's why I said people can use it to obtain shares, but in trading, you don't care about that. You just want to buy the contract for a low price and sell it for a higher price. It's high. And then get out the trade. That's your only objective as a trader.
Got you.
And the main point of this is to illustrate that the profit difference of trading the actual company versus trading its options is significantly more lucrative on the option side. All right. You guys can kind of get the percentage difference, right?
Yeah, that's a huge difference.
Okay. So we're going to discuss really briefly the anatomy of the options contract, and then we'll pause unless you guys have time. I'll continue, but the other lesson gets a little bit more in depth. But I just want to give you guys this part, and then you can review those 2 videos I sent you, and then we can continue on another session. Okay.
I got like 24 minutes. What y'all looking like?
I got 15 more minutes.
Okay, but y'all want to? Could we rock for 15 more minutes?
Yeah, I'm gonna finish this slide and then y'all can ask some questions.
Cool.
Okay. So, and then I'm gonna actually show you guys how it looks on the trading platform. Okay. So when we're looking at options contract, there are 5 main parts of an options contract. We'll have the stock ticker. So if you are not familiar with the term stock ticker, it's the symbol or the 3 letters or 4 letters sometimes that represents the identity of that company. So we have Facebook, Meta, META would be their ticker. You have Tesla, TSLA would be their ticker. You have Amazon, AMZN would be their ticker. So it will be the letters that represents that company. Make sure that when you're buying contracts, you have the right ticker, because some companies have very identical symbols. Like you may buy something in a company that you weren't trying to buy. So make sure you are in the actual right company. So it's important for you to make sure you have the right stock that you're buying. You'll see an expiration date. This is the last day you can trade this contract. And so, like I said, in trading, you do not have to wait for the expiration date. It is actually highly recommended that you don't wait for the expiration date, especially as a beginner. When you are a little bit more advanced, people buy options on the expiration date because they're the cheapest. And there's something that happens with options called time decay, which we'll cover because it's a little bit more in depth. But just know that in America, you're able to get out of your contract before the expiration date. If you are in Europe, you can only get a contract on the expiration date. So that is the last day you can trade this. So if you don't get out of your contract by the end of this date, it becomes worthless. So it goes to 0. Even if you are in profit, you need to close out your contract. You have to sell it or exercise it and get those shares. But most of the time, we're just going to close out that trade and before the expiration date to secure in our profit. So then next you'll see is the strike price. This is the price you're betting the stock will be at or above by the expiration date. So that's what will be for your call contract, or the price will be at or below by the expiration date, which would be your put contracts. So something to keep in mind, in trading, we do not really care about the strike price. The only time I really care about a strike price is when I'm picking out which contract is going to give me a greater profit margin. But you don't have to, your price of the contract does not have to go up to that price for you to be profitable. The moment you buy a contract, and if you're buying in a call contract and the contract is going up, you will see profit immediately. It does not, it automatically starts to gain profit when it's going in your direction. It does not have to meet the price of the strike price.
That's what I was saying. I was like that number, like as long as it's going up,
yes,
you decide when you're going to take it out anyway before.
Right. You don't have to wait for the strike price to be met. Sometimes you can buy a strike price that the price of the stock is already above because you want to be able to be in a more secure trade, which we'll talk about a little bit more in depth later. But that is the price that you are betting. That's the price that you will look out for if you're planning on holding it through expiration. The next will be the type of contract. Remember, we said there's call contracts and there's put contracts. Make sure you're buying the right type of contract. If you believe it's going up and then you accidentally buy a put contract and the price goes up, it's going to screw you. So make sure you are actually picking the right contract. And this is how I'll teach you guys how to set up your trading so that it doesn't, sometimes some platforms will show both of them at the same time and you may click by accident. But I separate them. So I have them on 2 different options so I can switch between them to make sure I'm not buying the wrong contract. And the main important thing is the option premium. This is what you're paying for the contract. So this price, this right here is $3.10. That is not what you're paying. Remember, options contract represents 100 shares. So this contract is representing just 1 share. So you'll have to multiply the premium times 100. So this person will actually pay $310 for their contract. So, and contracts can go from like $1 to like, 500. I think Rob got kicked out or something. So that is the price you're paying for with the options premium there. Any questions?
No, I'm looking at that. Nope, I think, man, you broke it down really well. Cause yeah, only question I had about the strike price, and then you answered that. I was like, well, do you have to really wait until it gets to that point?
Mhm.
Yeah.
Nah, we don't. All right, so that's the basic structure of the options contract. I'm gonna take you guys to Webull, and where I'll be able to show you guys how it looks in real time.
Oh, question.
Mhm.
So you said many people don't wait. You said it's best not to wait until the last day.
Yes,
Why you say it's best to not wait until the last day?
this is what we're gonna cover next time, the Greeks of
Okay.
options. And
Okay.
so I'll tell you
Oh man, it's nice.
what factors comes into play when it comes to the options contracts and what to look out for when you're buying a contract and when you're in a contract.
Okay.
So that will be a little bit more in depth. I don't want to overwhelm you with this
All right, for
information
sure.
right now. I want you to get the foundation, watch those two
Yeah, I
videos.
think I'm just gonna look at
And
two
then-
videos and make flashcards out of these. Out of these 5
And then,
things.
yeah, and then you can even play around paper trading with just that basic knowledge you have to kind of get your finger wet in options. But we'll go into the Greeks next, because that's
Okay.
one of the most important things to know about options contract is how to look at their Greeks and utilize that to buy your contract and to stay in your contract.
Got you.